Hello everyone, welcome to another episode of Mind Map. Today's topic of discussion is money market. First of all, we will discuss what is money market versus capital market, types of money market, instruments of money market, and importance of money market in economy. First of all, let's discuss what is money market. Money market is a component of financial market which is concerned with highly liquid and short-term funds usually having maturity of less than a year. Money market enables institutions to borrow funds to meet their short-term requirements. It operates through various instruments like T-bills, commercial paper, cash management bills, etc. Now, money market versus capital market. Money market deals with short period fund requirements, whereas capital market deals with long-term fund requirements. Money market is comparatively more liquid than capital market. Money market is relatively less organized than capital market. Money market is more secure compared to capital market, in which there is high risk involved, and rate of interest and maturity term is more in capital market. Now let's discuss about types of money market. First is call money market. It is interbank money market where funds are borrowed or raised for one day. Thus, it is also known as overnight borrowing market. Rate at which money is raised or repaid is known as call rate, which is equal to repo rate. Banks are the major participant in call money market. Bank which seeks to avail liquidity approach call market as borrowers, while those with excess liquidity acts as lenders. Notice money. If money is borrowed or lent for period between 2 days to 14 days, it is known as notice money. Term money. When money is borrowed or lent for period of 15 days or 1 year, it is known as term money. Participants: scheduled commercial banks excluding RRBs, cooperative banks other than land development banks and primary dealers are permitted to participate in call notice money market both as borrowers and lenders. Eligible participants are free to decide on interest rates in call or notice money market. The call or notice money transactions can be executed either on NDS call, that is negotiated dealing system call, a screen-based negotiated code-driven electronic trading system managed by the Clearing Corporation of India, or over-the-counter through bilateral communication. Now moving on to instruments of money market. Money market can be organized or unorganized in nature. Unorganized money market. They are neither regulated nor they are under any supervisory control. It is mostly informal. At times, the lending activity is based on interpersonal relations. They charge very high interest rates. They include unregulated NBFC like Nidhi and Chit funds who lend only to their members, local money lenders. Organized money market. Instruments of organized money market are formal and often legally backed. Interest rates are highly regulated, often matching with repo rates. The transactions in organized money market are more secure. Instruments of organized money market are T-bills, commercial papers, certificate of deposit, cash management bills and commercial bills. Treasury bills or T-bills. They are promissory notes issued by RBI on behalf of central government. They are sovereign in nature, thus they are highly secure. They are zero coupon securities, that is, there is no interest received in these securities. Rather, they are issued at a discount at a reduced amount and redeemed, given back money at the face value at maturity. Difference between the two is the total profit to the purchaser. They are presently issued in 3 maturities, namely 91 days, 182 days and 364 days. Due to their maximum maturity of 364 days, they are categorized as money market instruments. Significance of T-bills are used by RBI as a tool to control liquidity in the economy. For example, T-bills were issued during open market operations of RBI. Used by the banks to fulfill their SLR requirements. Often they are used as collateral by banks and RBI during repo operations. They are used by government to finance the budgetary shortfalls. Limitations. They have reputation to give low yield. There is no scope for increase in returns received by borrowers. They are subjected to short-term capital gains tax. Commercial paper. Commercial papers are usually issued by corporations with high net worth, often categorized as blue chip companies. They are unsecured in nature, issued in the form of promissory notes and held in dematerialized format. Commercial paper is usually issued at a discount from face value and reflects prevailing market interest rates. Who can issue commercial paper? Only corporates with high net worth with investment grade ratings can issue commercial papers. Banks and financial instruments are prohibited to issue and underwrite commercial paper. Significance: they are used by big companies to finance payroll, accounts payable, and inventories, as well as meet other short-term liabilities. Limitation: the proceeds of commercial paper can only be used on current assets or inventories and are not allowed to be used on fixed assets such as new plant without SEC involvement. Certificates of deposit. A certificate of deposit or CD is a product offered by banks and credit unions that offers an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a set period of time. They are unsecured and negotiable. Maturity of CD for commercial banks ranges from 7 days to 1 year, while for financial institutions it ranges from 1 year to 3 years. They are issued at value lower than face value and they don't offer any interest on the deposit. Minimum amount that can be invested in CD is 1 lakh, while rest of the amount should be in multiple of 1 lakh. CDs can be issued to non-residential Indians on non-repatriable basis. Who can issue certificate of deposit? Scheduled commercial banks except RRB and local area banks and financial institutions permitted by RBI. Significance: it widens the range of money market instruments to provide higher flexibility to investors. Limitations: they have comparatively less liquidity with early withdrawal amounting to penalty. Rate at which CD is issued is not indexed to the inflation. And banks can't provide loans against certificate of deposit. Commercial bills. The commercial bills are issued by the seller drawer on the buyer drawee for the value of goods delivered by him. If the seller needs funds, he may draw a bill and send it to the buyer for acceptance. Buyer can either accept the bill or can approach the bank for surety. The bank charges a commission for the acceptance of the bill and promises to make the payment if the buyer defaults. Once this process is accomplished, the seller can sell it in the market. These bills have a maturity of 30 days, 60 days, or 90 days. The commercial bill is either payable on demand or after specified time. It can be issued by AIFI, NBFC, SCB, cooperative banks, and mutual fund. Significance: commercial bills offers higher yield. Due to backing by banks, they are secure and certain in nature. Limitations: absence of rediscounting among banks for commercial bills. Due to absence of discount house or acceptance house in India, use of commercial bills is very limited. Now lastly, let's discuss about relevance of money market in economy. Facilitates development of industrial sector by completing short-term liquidity demands. It enables the smooth functioning of banking sector as few money market instruments help bank in maintaining statutory requirements like SLR. Money market instruments are effectively used as tools in monetary policy and fiscal policy of country. They help in controlling inflation and regulating fiscal deficit of Government of India. Now it's time for the practice questions. First of all, prelims question. Consider the following statements. 1. Certificate of deposit is a long-term financial transaction instrument predominantly used by blue-chip companies to attract foreign investments. 2. Money market is prone to risk of market fluctuations due to high involvement of hedge funds and venture capital funds. Which of the following statements is or are correct? Both 1 and 2, 1 only, none, or 2 only. And now mains question. What are the major determinants of money market? Was role of money market role in economic development of nation in past decade limited as compared to capital market? So that's all for today. Stay tuned for the next episode. Thanks for watching.